Dan Cook, the senior market analyst at IG Markets, and Joe Saluzzi, the co-head of equity trading at Themis Trading. And Joe, let's kick things off with you. So we just heard from Robert Eisenbeis. He says there's still a lot of concerns out there. I'm assuming you agree.
You know, absolutely. Long term, we've got lots of issues. Short term, different story. These trading markets that we've seen, yesterday was a perfect example of a stock market that doesn't care about news. It just goes straight up in lieu of news, right? 175 points on really nothing.
Yeah, but we've been selling off over the last, 4 weeks?
True. Actually, since the last time I was here, it was down about 5%.
Right.
Look at that. I should have showed up a few weeks earlier. We have been, but I think most people think it's a small correction and they're going to rally back. To be honest with you, it is a trader's market. It could do anything at this point. Long term, major problem. Yeah, lots of volatilities intraday. You got the machines, you got the quants pushing things around, the highly leveraged funds. It really makes it difficult for a small trader to figure out what's going on. Longer term, if you want to take a position, major problems, unemployment, housing, deficit. We go through it every single time.
Right.
But short term, people don't seem to care still.
All right, Dan, let me bring you into this. Do you agree with Joe? Lots of problems out there?
I do. We really have a
two bears. This is dangerous.
Not necessarily a bear, because I do think if we did see a decent correction, maybe down to the 8,000 level at an extreme, we'd probably build a nice solid base. It'd probably be a lot healthier for the market overall.
Because we've had such a run-up.
We have had such a run-up. We probably overdid it the first crash down.
Right.
So I'm not expecting something at that level. But we'd probably have a lot of that money that's on the sideline come back in at a level where they'd feel a lot comfortable, build that base, and we'd probably be a lot more stable moving forward from there.
Well, Joe, let me ask you. I mean, Walmart, they come out with better than expected numbers. If we get that tomorrow, that's a good sign. The world's biggest retailer gives you an indication of what's going on with the consumer.
I do think that's more the trend toward discounting. I think Walmart, Costco, I think you had the guy Howard Davidowitz on recently. You know, he was talking about the Dollar Trees of the world and the Family Dollar stores. That's where the money is, because people are all low-ending at this point. There's still no money in the economy. But if I can go back to one thing from the Fed minutes, everybody's talking about the mortgage back. When's the Fed going to start to sell? I don't think we have to worry about that. I think they're going to continue to buy, whether it's through their own Fed program or another program. They've done this time and time again where you think they're going to stop and they start up again. And that's why my bearish thesis probably won't hold again, because they're going to come in and stop the downtrend.
So you blow off any of this upbeat economic?
Yeah, I still think it's all about the Fed. I think it's all about when they're going to stop the stimulus, the federal government, when this economy will eventually turn. Walmart, great. That's fantastic for one particular company and that deep discount sector.
But we've also had earnings. I mean, Dan, help me out here. I mean, we've had a lot of corporate earnings, 75%. Hang on, Dan Deming out in Chicago. I got a Dan here in the studio. I mean, we've had, 75% of the earnings that came in, they're coming in better than expected.
They have been positive. Again, though, it's kind of one of those things where they've mostly been overshadowed. We've had China, we've had Greece, we've had things that, other than a few single stocks that performed all right on a single day.
Right.
Again, kind of going back to the fundamentals, we mentioned how the upbeat fundamentals should typically help a stock market. In this case, though, it might have the opposite effect, because as we hear the Fed talking about reverse repos, term deposit facilities, if we start getting this positive data in series, this is where the bearish theory really comes in. As the economy starts to improve and we see the Fed move to these tightening policies, this was a liquidity rally and really nothing more.
The president came out today, talked about the stimulus program. It's a one-year anniversary. I mean, talked about saving 2 million jobs. I mean, without that stimulus, we would have been, in a much worse situation, correct?
Probably. However, when I look at recovery.org, they only show 600,000 jobs. So which one do we go with?
I know, and he dealt with that issue. I mean, nonetheless, things are better than they were a year ago.
Things are better, definitely. However, I think we've got a lot of work to do. One of the reasons is a lot of nuclear engineers were not laid off during the recession. So these high capital, low employment jobs that we've seen, I mean, we've had different structures for 1.5 billion added 600 jobs.
Right.
In the 30s, we were able to do the WPA, where in 1 year, for the equivalent of today's dollars, less than 100 billion, we added 4 million jobs. How about maybe a bucket of paint and a paintbrush and put people actually to work that don't have the master's degrees in nuclear engineering and the common person on the street to really help out Main Street?
So go for the quantity here.
Yes.
Well, I think the problem is people are unemployed. The new jobs aren't coming out. Maybe the slowing of the firings, right? But we're not seeing the hirings. And here's a quick fun fact. If Congress doesn't extend unemployment benefits by June, 5 million people currently unemployed will have no benefits.
But don't you expect they will?
Of course they will, which means $22 billion more of stimulus, which means higher deficits, which means we're never going to pay this stuff off.
So, guys, I'm going to throw it back to you. I mean, Joe, I know there's a lot of concerns out there in the market, but again, it looks like certainly the company's, the corporate profit picture continues to improve.
I think they're doing it still with cost cuts and so on, and I think some of these earnings estimates are very low. These Wall Street analysts seem to be missing everything. I don't know who's working there anymore, but I'll tell you what I fear most, and I think we're heading in towards a situation. The global climate now is ripe for a situation where there's a crisis.
Because of Greece or what?
Well, it could be many things. It could be many black swans we don't even know about. But we'll head towards a long-term capital type crisis where you'll get margin calls and a massive deleveraging. And then what happens is everyone tries to sell at the same time, and the bids and the buyers that you see in the market now will disappear. They have no obligation to maintain orderly markets anymore. They'll just disappear. The price vacuum will start, and we're going to plunge down. And that's my big fear. When that'll happen, who knows? But it will get to that point.
Dan?
It's not impossible, sure. I'm not quite that bearish. I think more along the time.
Well, where do you think Joe is wrong?
As far as the vacuum plunging, I was taking it as maybe a 5,000 level on the Dow. I'm not quite that bearish.
Oh no, I mean, my vacuum could be 5-10% a day or something like that, but it just means more like the price action changes. All of a sudden, the bids that were there and you needed to sell stock, it's not there anymore.
In that case, I'm in more agreement.
Right.
I was picturing something much more severe from the vacuum, but then I'm definitely in agreement. And those are the types of dynamics we see. Is it the Fed tightening? Is it Greece? Is it Spain? Is it Portugal? Is it a domino effect where we start to see the southern part of Europe just topple on debt? Is it California or Illinois?
Or the states here.
Right. Where do we go from there?
No, that's a good point, because if you take it back a few weeks or a few months ago, it seems like everybody's saying, okay, it's getting so much better, so much better. The tone has changed again, and to me that says, well, maybe.
Right. We're long-term bears, but we're also, Dan and I agreed that short-term, you take what the market gives you. A long-term trade nowadays is a day or two. You can't go beyond that because there's so many outstanding, outside events. So, yeah, we're long-term bears, but it doesn't mean that you have to fight the tape.
I'm with that. It's for me, it's day. It's in and out, and we see that in the price action. We see a lot of people do that. We'll see a rally, oftentimes followed by a sell-off. We didn't quite sell off today after this rally, but who knows what tomorrow brings. We see a lot of profit taking very quickly.
All right, let me ask you guys, because we're talking about 1 year versus the stimulus plan, the anniversary. Just got a few seconds left here. Do you think that once we withdraw the stimulus, bottom line, you think that the market's going to start to fall apart?
Absolutely. This economy can't hold its own. Take a look at housing. It's a total disaster waiting to happen. Nobody wants to modify a mortgage anymore. All the government programs seem to be failing there. The economy has shown, the Fed has shown time and time again they're going to continue the stimulus, but so we don't know when that's going to stop.
Dan Cook.
Housing was a perfect example. They pulled back the tax credit or not extend it. That month and a half, we watched housing drop off 16%. We're just not quite there to stand on our own yet.
Dan Cook of IG Markets and Joe Saluzzi of Themis Trading joining us right here in the studio. Guys, thanks so much.
Thank you.